Oh, aloha everyone, Joshua Hayes at bigwavetrading.com. Just wanted to make a video lesson going over the SPY, the IWM. Then we're going to look at some of the top current holdings, which it's really the same ones which we've already showcased on the public video lessons that I'm doing for the social media YouTube community. But let's go ahead and just start it off right with the SPY. This past week, wow, heavy volatile news flow, and what you even see here on the chart from 1, 2, 3, 4, 5. Look at the past 5 sessions of the SPY, and even the after hours session each evening almost was absolutely crazy. The first after hours session that I've seen in a long time, since back here, that even remotely looked bullish, was before Friday's session. However, the bullish early action in Friday's session left us with a nasty, like shooting star candle pattern. And I want to show everybody there's one bullish item to take away from this. That is the 3 EMA has crossed above the 9 EMA. Remember, this is one of for me to even be remotely bullish on the short term, even if I believe that we've seen a bottom anywhere like following a sell-off, I need to see the 3 EMA get above the 9 EMA at least. I mean, that's a bare minimum for me on short-term trend to be bullish. But that being said, when it crosses 3 and 9, it's always going to be more bullish when TSV is green, positive, above the moving average line. And it's especially bullish, look right here, whenever you can get the green and get the M trend squeeze indicator moving up, and especially whenever it comes. Like here, see how it's flat? Then you get the 3 and 9 EMA cross. Whenever you have green in the M trend and TSV, it's always, more often than not always, I should never say that. That's not how the stock market works. Nothing is written in stone. It's a very geometrical, not linear entity, so you have to trade accordingly. It's always best to have an open mind to things, but the 3 is above the 9, and the bottom line is, while the M trend has gone positive, there is no green yet in this M trend squeeze indicator, and I normally only like the crosses when I see some green. That being said, TSV is negative on the daily. Moving average line is still heading lower, and obviously each longer term time frame supersedes the short term. TSV is not pretty at all on a weekly. You can see last time it was green and uptrending from the moving average on a weekly basis. We had a nice move up in the market. And on a monthly, hey, if you've been wondering why we've been so ugly here, there was one indicator that could have kept you safe if you only went long on a monthly time frame, and that's that trusty time segment volume, which has been negative since September 18 and continues to be negative. Now, with these two indicators, I just want to look at the IWM, which represents the Russell 2000, which is like 2,000 small cap stocks, yada, yada, yada. Monthly basis, M trend squeeze has been, TSV, time segment volume, has been negative since June of 2018. That last hurrah moment, you can see, how would you have stuck with it? Well, the M trend was still uptrending in green, even when TSV was negative. But it was a precursor of what was to come. And as we look right now, that's not good. And we can see the 3 is below the 9 on the monthly. Looking at a weekly time frame, 3 is below the 9. Not only is TSV negative, hey, it tried to go green there for a minute, and even that popped, and that was during that daily whenever we had what might have been at the time a pro gap because it came on heavier volume. We now know it was all gaps love to be filled in the market. Just remember that. So whenever you think about the gap from Thursday to Friday, just remember markets love to fill gaps when they're not breakaway gaps, and you can be for certain that was not a breakaway gap on Friday. So 3 is still below the 9. Red, you know what that means. Not the best market environment. And even on the Russell 2000 here, I have to look closely, but it looks like the 3 is at 148.88, and the red line, which is the 9 EMA, is at 148.93. So the 3 is still below the 9 on the Russell 2000. Time segment volume, even on a daily basis, is negative. Now, this is the one, M trend is kind of curling higher here. So we'll see what happens. But bottom line is, there's that gap I saw about in the IWM. It was filled, and I want to just go show you that SPY gap. Expect that to be filled at some point. markets love to fill gaps. Look, this gap filled, this gap filled, this gap filled, this gap filled. Pretty sure what's going to happen here. But all that being said, while a lot of things look bearish, short term, intermediate term, and even on monthly time frames of the market, I want to show you some things that are bullish. But to do that, I want to look at my charts on Telechart version 18. So if we look at the SPY on this chart, I have a lot of moving averages. I've hidden some, kept some alive. You can see here that I have a lot of different indicators that I look at. What you go here, you press on that, and then you can pin it to the side, and that's kind of how I just move the indicators around to just look at what I want to look at. But what I want to focus on right here before I draw all these horizontal lines and Fibonacci retracements is this market uptrend since the low here. This market has loved to come down and test initially the 200 exponential moving average, bounce off it, move higher. It even came down here and tested both the 200 and the exponential 200, bounced back above it. Then you can see down here during these August lows, bounced right off the 200 EMA, still holding above the 200 EMA and the 200 rising day simple moving average. So it's kind of hard to be too bearish overall when the market is still above the long-term moving averages. We get below the 200 exponential moving average and 200 simple moving average, then all those daily, weekly, monthly Madrid trend squeeze indicators, time segment volume indicators that are confirming that weakness, we really need to pay attention. I mean, it's already saying right now it's not bad, but these charts right here are saying, hey, it's not, that bad either. And then let's not forget, Apple's at all-time highs. Lulu is basically near all-time highs. Walmart, Costco, just a lot of stocks are at or near all-time highs. So the United States consumer is 68% of the economy. It looks pretty good, so it's hard to be too bearish on that note. Now, on a weekly basis, even more important, look at where the 200 EMA and daily moving average, look where the 200 weekly and 200 exponential moving average are on this chart. Why is that important? Because look at what happened in 2008. Let me go ahead and drag this over here just to show you what it looked like here. We went below. We were messing around here, then we finally cracked it. We retested those two key moving average, and that led to a nasty bear market. Okay, granted, so here we looked fine at the tip top, but still, you could said that here, oh, we might top. The only time I'm really starting to position heavily short and start to call for a top is once there's actual evidence of a top here. You'll also notice the 50 weekly moving average acted as resistance here. And then if we go back to 2000 to 2001, you can see you can call a top anywhere along here. Anywhere along here you call the top, but we remained above the 200 exponential moving average. Now, granted, we topped out here. We came back, tested that 50 weekly moving average and couldn't break back above it, which then led to us going below right here. I mean, already it was obvious that we were finally topping via stocks and other signals. If you go look at the TSV and the Madrid trend squeeze indicator, it was warning you before it happened. Could be happening now, but for right now it isn't. But you can see we finally rolled down below those moving averages, came back up to the 50 weekly, and then rolled back below, and you know what happened until we found the low, and then the same thing happened. We broke above the moving averages, came back, retested them all, and we've been moving up following that. Now, let's take that and extrapolate and move all that data to what we have right now. We're still above the 50 weekly moving average. We're still above the 200 exponential and the 200 weekly average. So there really is nothing to be too alarmed about here. And getting more short term, I have these trend lines. We're really just in a really range-bound market between these May-June lows and these July highs, and it goes back further because it's kind of encompasses this kind of trading range right here. So we're really just in between those two highs and lows. We also have that uptrend line, which kind of lines up with the 200 exponential moving average. We got above the downtrend line. Like I said, we're going to probably need to back test this overall, but things don't look too bad on this chart either. And another thing you can see here, I have a Fibonacci retracement tool measured from the low in December of 2018
to the high here in July of 2019. And you can see we've pulled back basically and have held at the 23.6% retracement line. We haven't even gotten down to the 38, much less the 50%. So we're actually holding up really well. It's just that the volatility is insane and it's wreaking havoc. Not havoc. I always have stops. I always cut my losses small. I normally try to get out at break even, except for initially whenever I get long a position. But the bottom line is there's been not a lot, because there hasn't even been that many swing trades. But the swing trades that I do take, they're not working, and there's been a lot of chop and volatility, and this is going to lead to the top current holdings that we're going to go over. You're going to see that there's only really 2 recent ones, and one is, they're both kind of boring overall. But following Friday's session, I didn't have any big losses in any one position. However, I was shaken out of half of my hedges. Following this session, I put on some hedges when we rallied back into this resistance, got almost all of my hedges back on. Looked like a very prudent move, but following Friday's session, a little shaky shake. I'm out of 50 of them. Now, I won't be out of all of them until we break out to new all-time highs, and you better believe mentally, I know that it's possible in this market that we break out to all-time highs and then come right back in. I understand the kind of beast that I'm dealing with currently. That's why I'm not 100% of my portfolio in hedges, which wouldn't make any sense, or else they wouldn't be hedges. They would be outright short positions. But I'm not putting 20% of my portfolio in these hedges. I'm not putting 20% of my portfolio into new long positions. I'm keeping them small. I'm keeping them to keep my feet in the water, to still be in flow with the market. I take long positions. Signals is signals, a signal is a signal in my methodology on an end-of-day basis. Intraday, I focus on stocks like we saw this week, like PFNX, ASUR, OCGN, SES. These are the kind of stocks that I focus on. And then on the other end, I also focus on stocks like Roku when they move with a catalyst, or Netflix with options. But that's a whole different story. The bottom line is, for the end-of-day swing positions and trend-following positions, I'm keeping them small. I put 5, 10, 20% of my account capital into positions when I'm in the right kind of market environment, when the 3's above the 9 on the daily and weekly, when the Madrid trend squeeze is green and time segment volume's green. That's when I push. But for right now, slow, steady, measured, just deal. Hey, going to get shaken out of some positions, not going to get filled on some positions with the volatility, and it's going to be messy, which then takes us to my top current holdings currently. For those that have been watching these public videos, you should be very familiar with this name, EURN. It continues to work perfectly, but you better believe after this rise, that volume bar there on a late exhaustion, that's called an exhaustion gap. On that exhaustion gap with that kind of like reversal, shooting star, was it a graveyard doji? Like, I really don't know all these candle names, but the bottom line is, it's a negative price action because it basically closed lower than where it opened after a huge gap on its biggest volume ever. It's probably an exhaustion gap. So you better believe I'm going to be raising some of my stops to the session's low a day. So if it trades at 11:18 tomorrow, or not tomorrow, on Monday in the stock market, I will be out of more of this position. That being said, this is a position that should have been a 3% position. This was the initial signal, the hammer candle, or excuse me, the kind of engulfing candle over candle on the heavier above average volume with the increase in green bop, but it gapped away and it pulled in, and I never got filled on that signal. This was the add signal. The add signal filled. Awesome. That day got long EURN, but guess what? This was also another add signal. Too bad it gapped away on me. Never pulled back to my good to cancel buy stop limit price. So instead of getting a 3% position in this, I only have 1% of my account capital in it. But that's fine for this market. This one could have easily have failed, like many of the others that I've taken that have failed immediately, that I've had to cut my losses on. That being said, hey, that's not bad. That's a 20% gain in 1, 2, 3, 4, 5, 6, 7 sessions. I'm happy with that. In better markets, a signal like this, 5, 10, 20% of my capital goes into it. Then, of course, you guys should also be familiar with HOV. If If you remember, HOV gave a long signal with this candle over candle, heavier above average volume with an increase in my balance of power indicator to max green. Remember, I confirmed these on RSI, MACD, stochastics, TSV, and Madrid trend squeeze in this market environment to make sure they are new long positions. At this time, let me see what the SPY was doing. I think it was still, it wasn't that bad yet. So HOV, I was just happy with the way this chart looked. And of course, it still continues to work. That being said, I want to be tight with stops. So if you got a large position, for instance, there's kind of an uptrend line that you would use, and you would just make sure that if it closes below that uptrend line, you want to get out of the majority of this name. That being said, I'm a little bit looser with my stops. I got to stop here. I got to stop there. I got to stop there. And then I got a final stop, I believe, for now right there, because I want to make sure that I leave this entire trade. If there's a nasty crash, let's say intraday Monday, and it just starts slicing through all my stops, I want to make sure that I leave with profits overall on the position. I'm not letting any winners turn into losers in this market environment. And speaking of winners, how about a 44% gain in less than a month with HOV despite the overall market? This is few and far between, but this is very normal using my methodology with the way that I look for potential end-of-day swing trade long positions. Can't remember offhand, but I always check short float. I believe HOV had a very high short float on this trade. And then ORGO continues to march higher. We should all be familiar with this name as well. This was the signal date back here. Let's take a look. You got the candle over candle, nice reversal candle over candle, heavier above average volume, pocket pivot point signal, max green bop. Didn't trigger the next day, triggered the day after because my good to cancel buy stop limit order is at 501. Remember, just because it triggers, I don't know if I'm going to get filled. There was a long position on Friday that I had as a new long position for members of the website. It worked, and it was up 6% to 7% intraday on the session, closed up 5.5%. However, it executed on an interactive brokers, but I never got filled, and it traded. There's time in sales, so I can see it traded below my limit price on this stock. My good to cancel buy stop limit price was 616. I saw trades after my order triggered for the interactive broker system. There were trades at 614, 615, 616, 614, 615, 616. I didn't get filled. I'm pretty sure I sent him a message asking why. I'm pretty sure there's going to be market makers, so there's nothing I can do. But on this one, got filled. We're long ORGO, and it continues to move higher. But you do notice it's lost its green balance of power indicator, and it's yellow now. So 50% of my stops are here. I believe it's all split up. I think I actually do have it in 25% here. Let's just keep it simple. 50% is here. 25% is here. 25% is there. But I believe what I've done, because I'm insane, I only pay $1 commissions to interactive brokers. And I only have to pay that because I use their API. 50% is here. Then on the final half, 33, 33, 33. Once again, don't want to see this one turn into a loser. And then the last one I want to profile is just a recent long position, ENIA. This is one of the very few long positions that have had everything line up. And as you can see, sleepy, boring, foreign utility stock. Either way, triggered and immediately filled the next session, and it's worked out perfectly since. But you can see it has consolidated. And since consolidating and re-breaking out, my balance of power indicator is decreasing. So what I have done now for this one for now, I'm willing to give it room to work. But 50% of my good to cancel sell stops is right here on ENIA. This ensures that I leave half the position with profits. You could even do 25% there, 25% there, $1 in commissions, $2 in commissions. And then after that, I have, if that's 50% there, I have 25% at break even. So it would be 1 penny above this high of the day. And my final stop is 1 cent below the signal date's low a day. And that's it. I don't think that there's anything else we need to go over, but just want to show you once again with ENIA, candle over candle. I don't always need to see heavier above average volume. I need to see either above average volume, heavier volume than the session before, and it's always best if it's heavier above average. but any of those 3 iterations will work for a new long position. All right, everybody, I'm going to go ahead and wrap this video up. Just want to remind everybody, hey, that news flow the past week and combined with the volatility was without a doubt the worst I've seen since early 2008 before the major sell-off. One thing I want to look at that I forgot to show you with the SPY charts, once again, with the weekly and even the monthly. Look at the SPY chart on the monthly. Notice this bottom indicator, the PPO. This is what I forgot to show everybody. So the PPO, you can see here. See where we're at right now on this monthly chart, how we're above the 0 line? This thing crosses the 0 line back in 2008, well before the big gigantic flush. This one is a little late in 2001, whenever it does close lower, but as you can see, there was still one final giant flush. We don't have anything like that right now. And when we look at the weekly, we're still above it here. In 2008, you can see we got below it, retested that 0 line, and then flush. In 2000, we got below it, never even could retest the 0 line until much later than flush. The weekly is still above the 0 line for now. The monthly is still above the 0 line. This is when you need to be worried. So we've looked at a lot of different things in this video lesson. I hope that helps you with the current market environment. And here's to hoping that the news flow settles down. We get some kind of trend. Up or down, I don't care. If we go down, I play puts. Puts. Puts on any high cap, big cap, highly liquid, a lot of open interest, a lot of intraday volume with at the money or slightly out of the money contracts. It doesn't matter to me. I'll adapt to the market. But we're also heading into the sweet spot for small caps intraday. So it doesn't seem like we ever get morning movers now. I live in a horrific time zone. And so I've been waking up early for early morning movers. And instead, it's been midday traps like PFNX, ASUR, OCGN, and especially SES, 2 amazing traps intraday on SES. Let's just go and pull up my 3-minute on there. I even have the Fibonacci lines drawn out because it held it all. Look at this trap, hold, trap, hold, reclaim of VWAP, consolidation at the trade line, and off it went, and even after hours. But it also held the 38.2 Fibonacci retracement the first time, and the second time it did the bounce back off the 50 right back above the 38.2. But it's all happening late in the day, and normally because I live in this horrific time zone in Maui, I'm normally asleep right around this time period. And it's lately, this is the make or break time period. So I'm going to have to start adjusting my sleep schedule to try to benefit from these late day intraday movers and or come back earlier than 2 p.m. This SES, I came back way too late. Right whenever I came back, it was starting that move. And after hours, it moved to 9. But wow. Hopefully this stuff is alive again. You also notice here on the PPO during this consolidation, it stayed above that 0 line the entire time. Just something only now I'm noticing. But I also want you to realize on this one too, late in the day, do you see this morning high here that lined up with that initial, the Fibonacci move that I do from the previous gap to the morning high? Notice how it was perfect intraday support right at 390 to the T. That is crazy. Look at what the high there is, 390. Look at what the low is here, 391. The candle before, 390. Unbelievable. What a move. Hopefully small caps are back. All right, everybody. Long video. Hope you enjoyed it. Aloha.